In September 2008, the American economy faced an unprecedented crisis, largely stemming from the collapse of Lehman Brothers. This event precipitated a catastrophic chain reaction in the financial markets, exposing the vulnerabilities within the financial system. AIG, or American International Group, found itself on the brink of disaster due to its extensive involvement in insuring mortgage-backed securities through complex financial instruments known as credit default swaps. As mortgage defaults surged, AIG faced mounting liabilities, culminating in the need for an emergency bailout. The government's swift action was considered essential not just for AIG's survival but also for the broader stability of Wall Street and the global economy. The decision to bail out AIG came with a staggering price tag of $182 billion, a figure that reflected the immense scale of the financial risks involved. Initially, the Federal Reserve intervened with an $85 billion loan, designed to provide immediate liquidity and stabilize the company. This loan was later expanded as it became clear that further assistance would be necessary. The rationale behind this unprecedented bailout lay in the interconnectedness of AIG with other financial institutions. AIG was not just a giant insurer, it had deep ties to banks, investment firms, and other creditors worldwide, and its failure could prompt a panic that would unsettle the entire financial system. Critics of the bailout argued that bailing out a massive corporation sets a dangerous precedent, potentially encouraging excessive risk-taking behavior in the financial sector, often referred to as moral hazard. They contended that such a rescue could send the message that large institutions would be shielded from the consequences of their actions, leading to a cycle of reckless behavior. In contrast, proponents emphasized the need to avert a financial catastrophe, arguing that the repercussions of a disorderly AIG collapse would have been exponentially worse. The stakes were high, and the government had to choose between minimizing short-term pain and preventing long-term economic disaster. As the bailout proceeded, the government took a controlling stake in AIG, effectively nationalizing the company in a bid to restructure it and recover the taxpayer investment. This involvement allowed the federal government to oversee the dissolution of risky assets and stabilize operations. The restructuring plan focused on unwinding AIG's massive portfolio of derivatives, while ensuring that crucial insurance services remained intact. AIG sold off various non-core businesses, raising funds to repay taxpayers, and gradually reduced its risk exposure. The transition was not without challenges, with significant public scrutiny regarding executive compensation and the ethics of using taxpayer dollars to rescue a corporation. Over the subsequent years, AIG's financial recovery was marked by strategic divestitures and a renewed emphasis on its core insurance operations. By 2012, the government began to sell its stake in the company, gradually reducing its ownership as AIG stabilized and became profitable again. The process underscored the dynamic of public-private partnerships in the contemporary financial landscape, where government intervention during crises is often deemed necessary to restore confidence and order. However, the exit strategy also highlighted the complexities of unwinding public equity in a company after a rescue, navigating market perceptions and regulatory constraints. The fallout from the AIG bailout rippled through the financial sectors and influenced regulatory reforms. In an effort to prevent future crises, the Dodd-Frank Wall Street Reform and Consumer Protection Act was enacted in 2010, aimed at increasing transparency and instituting stringent regulations for systemic financial institutions. One of its key provisions was the establishment of the Volcker Rule, which sought to limit proprietary trading by banks and reduce the types of risky investments that contributed to the financial crisis. Although the legislation was intended to create a safer financial environment, debates over its effectiveness and implications continue, as many argue it fell short of addressing the underlying issues within the financial system. The saga of AIG and its 2008 bailout serves as a critical lesson in the importance of regulatory oversight, risk management, and the interconnectedness of financial entities in a global economy. As financial markets evolve, understanding the key elements that led to the crisis remains essential for policymakers, investors, and consumers alike. Lessons learned from AIG emphasize the need for vigilance against excessive risk-taking and highlight the role of government in safeguarding public interests in times of crisis. Moving forward, the legitimacy of large-scale bailouts remains a contentious issue, challenging the balance between stabilizing the economy and holding corporations accountable for their actions. The AIG bailout, while extraordinary, also serves as a reminder that preparedness and oversight can help mitigate the impact of future financial storms and ensure that the lessons of the past are not forgotten.